Okay, we're going to get started by looking at the S&P 500. You can see that the S&P 500 right now is above all of the moving averages. This is the 50-day, 200-day, 150-day, and the 20-day exponential moving average. So that is a sign for momentum. Um, we are in a process of completing one of the worst months performance-wise of the year. June is typically at 0.02%, which isn't very good. Primarily because June, there's not a whole lot of news coming out in June. Most of the earnings reports are done, and we have government reports. That's about it. Um, right now, we have the specter of possible war in Iran, and that's getting the market to be a little bit cautious. You can see that we're at a stochastics, slow stochastics of 68 right now. That is, and we're going down. So we're still overbought, and we're well above the 200-day moving average. So there's a good portion of time. I mean, we can still go down a little bit and still be within our uptrend. So let's look at look at some of our talking points. Okay, we are in June. We had the Fed meet, and they mentioned that they're going to be reducing the interest rates twice this year as the plan. So, so when we hear that the Fed is reducing interest rates um, by possibility of 2 times this year, we have to start thinking about investments that will be beneficial, um, how stocks will benefit, and how stocks will not do so good whenever interest rates go down. So whenever the Fed said their plan is to have 2 interest rate cuts, that doesn't necessarily affect mortgage rates, because the last time the Fed cut, I think it was back in September of last year, the interest rates went up for the long um, U.S. Treasury bonds. So I think the only thing that the Fed can control is the short-term interest rates. But if the Fed is reducing interest rates, and we know the goal of the current administration is to reduce the interest rate for the 10-year, then we have to think about all the possible stocks and investments that could benefit from that. And we're going to see some of that today. Let's look at some more things that happened this week. We had a holiday, the Juneteenth holiday and 19th. And we had on the 20th, Triple Witching Day. So that was on Friday. Triple witching is whenever a lot of options expire. Actually, options expire every day. However, a couple times a year, we have them in red here. Every two, every 3 months, we have a triple witching, which is a lot of the expirations happen at the same time. So if we have a volatile day, like we did, we had a negative day, then you have to basically ignore that, because there's a lot of people buying stocks, selling stocks in order to fulfill their options agreements. Right. So we're coming in. Okay, we have a couple things happening in June. First of all, we have end of quarter window dressing. That is the last week that we're going into. That means the stocks that did well this quarter, a lot of mutual fund managers are going to buy them at the last couple of weeks of the month. The other thing that happens is we have a Russell realignment, which is the Russell 2000 index re readjusts every couple of months. And this happens to be the time that happens. So that could be a catalyst for um, small cap stocks, such as stocks in the IWM, the small cap ETF. Okay, so Then we have July, which traditionally has been a really good month. Let's look at July. It's usually got 0.79%, which is one of the better months. And we have earnings coming out in July. We have Citi, JP Morgan, Bank of America starting things out. The banks usually start out earnings season, and that's going to happen July 14th, the week of July 14th. Then we start getting some of the tech stocks reporting. We have Google reporting, Apple in August, and then we have NVIDIA, one of the last ones at the end of August. So that's a catalyst for stocks to go up or down. So that's why we have we have July as a good month. We have 4th of July coming up, and a lot of times this is one of the most visible holidays of the year, and people are really excited and they look forward to that holiday a lot. And with those good feelings, usually the stock market goes up around the 4th of July. That's why I have green for around the 4th. But we do have a period of time where it looks like we're consolidating. So the next week or so until the 4th of July, it looks like we could be in for like a consolidation. We're starting to go down just a little bit here, and we still have we're at 60 in the slow stochastics. We can go down to like maybe 10 before we're oversold. So don't be surprised if we go down just a little bit more in the near future. All right. And the reason why we're doing the trying to understand these short-term moves in the stock market in general is if you're not invested, or if you have some money to invest, it's a lot of times it's good to buy stocks when the stock market is oversold and no one is buying. Um, so that's when we're trying to get that good time to start buying or buy, initiate new positions. Okay, so let's look at some more talking points. Okay, S&P is down this week. You can see that we were down a good 3% this week. There's a lot of fear about possible U.S. involvement in the war. So if there's a war um, involving the United States, the stock market's going to go down. We're going to have, we mentioned last week, the three things that happen are the stock market usually goes down. We have oil that usually goes up. We have um, interest rates usually go down. And as a flight to safety, and safe investments are going to be popular. But as an investor, you have to be ready for any situation. A diplomatic solution without being in a war, you have to be ready for every possibility. That's why we're going over all these things beforehand. Okay, so let's look at we're losing a little bit of momentum. We have 45% of stocks over the 200-day moving average, and it was 47 last week. So um, we have the treasuries going down. We have the 10-year going down 0.5% and the 2-year going down 3%, which is a lot. So I think what's happening this week, the stocks are going down, and there's a flight to safety. When there's uncertainty in the world, and especially involving the United States, people buy more bonds, and that makes the price go down of bonds. So there is a stronger demand for bonds this week. So that's why that happened. Um, Let me see. What else do we have to say here? Okay, so let's look at the S&P 500 chart. You can see we're at a kind of an inflection point right now with the S&P. Let's zoom in on this a little bit. Okay, you can see that we're right at the tip of the exponential 21-day exponential moving average, and we're at the bottom of our trend line. So right now the trend is lower high, higher high, lower high, higher high. And, we are going into one of the slowest times of the month, this summertime. So we very well could be stuck in this trading range like this, or I'm not sure, but it's going to be really hard to um, break out of this pattern while we have a potential of a war and we have a lot of uncertainties in the stock market. Another thing that's happening this this coming July 9th is we have the tariff situation that was delayed from earlier this year. So with that uncertainty, it's going to be really hard for the stock market to break out until we know what's going to happen there. So it looks like we're kind of stuck in this trading range right now. All right, so let's look at some more things. Okay, let's look at the 10-year Treasury. We have the yield for the 10-year right here. It's been going down, and the stock market has been going down with it, which until now we've had this inverse correlation. So this week it didn't work out. It's like a one-to-one correlation. So I think this can be attributed to potential of the United States dropping a bomb or being involved in the Iran war. So if the United States does go into the war, stocks go down and the yields go down. So there was like a fear trade this week. That's why that happened. So yields will go down if the United States gets into a war because there's a flight to safety and people will be buying bonds and that will make the yield of bonds go down. Let's look at major variables in the stock market. The price of oil went up again this week, around 5.5%. So the supply of oil might go down if there are problems in the Mideast. Specifically, um, there's a Strait of Hormuz that basically 1/4 of the oil in the world goes through. So if that is blocked by Iran, there could be a major escalation in oil prices. So until that situation is resolved, we're probably going to see higher oil. Um, Another thing that's happening is the dollar has been going down. So you can see as the dollar goes down, oil and all commodities that are priced in US dollars should go up. And that hasn't been going up. So you have two things, two pressures with commodities and oil. You have the pressures of potential war and disruption of supply. And you also have the dollar, which is going down. So let's see what else is happening here. We have the price of gold down 2% this week. Let's see what the dollar index. Dollar index is up 0.5%. It's in a downtrend, but it did go up a little bit. So if we have our formula, as the dollar index goes down, commodities go up. So what happened this week, as the dollar index goes up, commodity prices should go down. And that could be why gold went down a little bit. All right, so let's look at our fear and greed index. Fear and greed index is neutral right now. So there's no action to take. That's our translation. So last week it was greed. And as the stock market goes down, people are getting more of a neutral stance. It isn't until we have extreme fear that we are really looking to start buying. Or whenever we have extreme greed, it's the time we take profits off the table or don't buy. So now we don't have any real action to take. If we look at the American Association of Individual Investors survey, we have a bearish for the first time in a couple of weeks. So We have amateur investors that are afraid of investing right now, and that is an indication that we buy or don't sell. So we have to think contrary to what the majority of people are thinking, and that's a good way of approaching investing. Let's look at the VIX. The VIX is at 20 right now. So that is right on the edge of a bull market or fear is starting. You can see that we had a very low VIX for quite a long time. This is still kind of low. 20 is kind of low. So people aren't panicking yet, and they're not afraid, and they're not protecting their positions at this time. Um, so if we look at our emotional graph, right now we're at pretty much neutral. So we're at the top of this peak. If we look at the stock market, you can see that we're basically peaking out right now. People are neither neither fearful or greedy. They're kind of in between, and they're and so we don't have a whole lot of bias, either bullish or bearish. So let's look at the issues that may lead to a crash that happened this week. We had a war in the Mideast, Iran and Israel. We don't know how far that's going to escalate, but any kind of uncertainty with the United States being involved in a war, um, that could cause the stock market to go down. Let me see. Okay, we still have a weak dollar, and that could make the price of commodities go up, and that could cause inflation. We have U.S. economy is slowing down. It's not slowing down enough to go into recession, but it is slowing down. And let me see. Okay, that's all. That's all that could cause a crash this week. But right now, we the biggest news story will be the United States involvement with the Iran war. We have a 2 week time period where that's going to be decided. The second thing is the tariff deadline, which is going to be this, June 9th, July 9th. That is coming up in 2 weeks. So be ready for a very volatile stock market whenever those tariffs are placed. All right, so okay, look at the PE ratio is currently 23.58. That is relatively high compared to average. So um, so don't be afraid, don't be alarmed if we have a pullback in the stock market and the stock market has a PE of 17, which has been 16, 17 has been the average for the past 50 years. And let's see what else is happening. Okay, let's look at the first to worst, or our first to worst. At the beginning of the last year, we had IT, communications services, and consumer discretionary up 30%. And the worst performing were consumer staples, energy, and healthcare, and real estate. So this year we're looking for that to switch around. And the best performing sector this year has been industrials, up 8%. And the second best is consumer staples and financials. What do these have in common? Um, they all pay dividends, and they're all relatively conservative investments. And um, what other reason? And there's a steady demand in good times and in bad times. So let's look at the worst performing sector, consumer discretionary. Um, that's a good. People look at the consumer discretionary sector to determine the health of the economy because consumer discretionary purchases are made on items that you don't really need. You don't really need a new car every year. You don't really need to go on a vacation. You don't need to, mm, you don't need to buy a new house. So there's a lot of, or buy a Tesla. That's example of a stock that's in the XLY. So as the economy, as people pull back in their spending, they spend less on discretionary items. So, and this has been a surprise. Healthcare is down 4% this year. It's been down 1%, 1%. It's been down a lot for the past 3, 4 years. So, so why is it down this year? It is a sector that pays dividends, and it is a sector that has stable demand for their product. People don't want to die, and they want to take their medicines. So let's keep watching that sector this year. What other things are happening here? Okay. All right, let's look at some of the stocks that are going up and down recently here. Um, okay, Kroger, what do all these stocks right here have in common? They're all flight to safety stocks. We have Kroger, they sell grocery items. They pay a dividend, and there's a steady demand in good time and bad. We have a lot of home builders that are up. We have Lennar, which is a home builder. We have NVR, a home builder, DR Horton, a home builder. This could be a time when home builders start to, I mean, they've been down and out for quite a while. We know that interest rates by the Fed are going down 2 times this year. So I thought it'd be interesting to look at the chart of some of these home builder stocks. Um, you can see that this is NVR. It's a home builder. You can see that it's in a tight trading range right here. You can see that it's been in this trading range since March. And a lot of times, whenever you have some catalysts and you've been baselining for quite a while, these stocks have a potential of outperforming. So we're stuck in this trading range right here, but um, the home builders have a catalyst where this interest rates are going down. So we have two hints that the interest rates are going down. We have the Treasury Bassett saying that our main goal in this administration is to reduce the 10-year interest rate so we can afford our debt payments. So we have that, and we have the Fed that said that last week that we're reducing interest rates twice this year. So that's going to really help the home builders. So this is an example of a stock that's home builders have traditionally had a very low price to earnings ratio. Um, let's look at this BZH. It's a very similar chart. It's almost identical. You can see it's kind of like in a little trading range right here, and it's a little bit. I think it's a little bit oversold. Yeah, look at this. NVR is oversold. You can see it's at 20, 25, and this those stochastics. And let's look at Lennar. Lennar is another example of a stock that's oversold. It's at it's been baselining for a couple months now, and it's a little bit below its moving averages. So there are some people that wait for the stock to go above its exponential 21-day exponential moving average before they start a position. That's that yellow line right there. So we'll keep our eye on that. The yellow extended moving average, exponential moving average. Okay, so let's look at Lennar and their estimates. Lennar, okay, from this year to next year, 13 divided by 15. 13.03 divided by 15.12. Okay, so it's growing 14%. Um, okay, let's look at NAR. Okay, the NAR's P ratio is 8. So if it's grown at 14% and it's an 8, that means it's a little bit undervalued. So I think in the future I'll do a write-up on the home builders because we do have a time right now where they're out of favor. No one wants to buy the home builders, and we have a catalyst of potential interest rates going down. Okay, so what other things can we see in today? We have um, Mondelez food company. So they pay a dividend and they have a steady demand for their products, such as candy and snacks. We have, okay, that's a good little exercise. Let's look at the top decliners. Hmm, okay, we have Accenture. Why would they be down? I'm not sure. Accenture does consulting for AI, so that's involved in AI. We have Alphabet, which is an AI related company. We have Oracle, data center. They do a lot of data center work right now. Um, and Meta. Okay, so we have a good portion of these in the top decliners involved with AI in some way. So we have a risk off environment whenever the high flying companies that are high growth are pulling back. So we have basically a risk off environment today for the S&P. All right, that was a good exercise. Let's go to Dan Now's best picks for this year. Cisco is up 12%. This is turning into his best pick. And KBWB, the banking ETF, is up 3.7%. And his other ones aren't that great. This is the mid cap ETF, which is negative 3%, and ADTN, a networking play on a data center, is negative 5%. Okay, so, and why is Cisco up 12%? It's more of a conservative stock. It has a very low PE ratio, and they're getting into software. They used to be like a switch company, a hardware company. Now they're getting into, they bought a company called Splunk, and they're doing a product line that is not only hardware, but it involves software too. So you do some kind of security within your hardware. And so you have a one company that offers both security, antivirus, and the actual hardware. So they got a little niche there, and they're working with AI data centers too. So let's look at some of our charts of interest right now. All right, we have Costco. Look at this. It's oversold. It's the slow stochastics is down to 2, which is as low as you can get, and it's at the low end of its trend lines. And we know that Costco is super overvalued, but it's always been overvalued. So it commands a very high premium because it gets maybe 90 or more percent of its money from member fees. And most people renew, like 98% of members renew. So it's a consistent flow of money from members. But right now they're down to the bottom of their trend line. So if you're interested in acquiring this is probably a good time. Let's look at MasterCard. MasterCard and Visa are very similar charts. You can see that they're in an uptrend for at least several years. They're at the very low end of their trend line and they're oversold. Right now they have a bad news story that came out about stablecoin. There is a big push by the current administration to allow stable coins in America and to facilitate stable coins. And that could be a competitor to Visa and MasterCard. So one of the hardest things as an investor, of a buy and hold investor, is to determine potential competitors to a monopoly. So we have a couple companies that we're following right now that have potential competitors. And we don't know the extent of that competition probably for a couple of years. But in the near term, there is a little bit of fear in the market for these credit card processing stocks. Okay, so okay, we're oversold and we're at the bottom of its trend line. Let's look at Visa. It's almost exactly the same chart. We're oversold at the bottom of their trend line. All right, so let's look at another one, Walmart. Walmart is oversold at 16 and they're right in the middle of their trend line. So I like to wait for a stock to go down to the bottom of its trend line before I start buying. Let's look at Verizon. Verizon is very low on its slow stochastics. So it's oversold as much as you can get. And it's near the low of it's at the low of its trend line. So this is a stock that that gives a yield of around 6 or 7%. And it's a telecom stock, which is kind of in favor right now. Here's another stock, Procter& Gamble. There's a trading range going back multiple years. This stock is an example of a stock that has some issues with tariffs. They do a lot of business overseas. They're affected by the US dollar. Um, but they're oversold. They're as oversold as you can get and at the bottom of their trend line. I like to point out whenever stocks are either at the top or at the bottom of their trend line and when they're oversold. Let's look at Altria. Altria is an example of a stock that yields around 7% and it makes cigarettes for America. And as the interest rates go down, we know our formula is that stocks that pay a dividend usually go up or in higher demand. So we'll keep an eye on Altria. I did a stock screen this week, and this time I sorted by forward EPS long-term growth. Sometimes you get some good ideas if you look at the different categories. Like sometimes I sort by PEG ratio, sometimes I sort by return on equity. This time I sorted by forward EPS long-term growth. And I found an interesting one here. It's DoorDash. And this stock is an example of a stock that's a leader in its category, is actually the most used food delivery company in America. So it has pricing power as the leader. And let's look at some of the statistics of DoorDash. First of all, the forward PE is 98. That is pretty high. So if it's at 98, it better be growing around 98% for it to be fairly valued. And actually, if we look at the growth rates from last year to this year, it grew 626%. So it grew from earnings of 55 cents um, well, it grew a lot from 30 cents to $2.18. So it looks like it's a high growth company, and it has a business model very similar to Uber, which it doesn't have a whole lot of capital expenditures. It um, doesn't pay for the equipment being used. The end user, such well, there are deliverers that use their own cars, and so they have a very low cost, um, low expense business model, similar to Uber. Let's look at some of their statistics. We see the PEG ratio is 1.12 according to Yahoo Finance. The profit margin isn't that great. It's like really low. We like to have at least 13, and they have a 3. Return on equity is kind of low too. It's only 4.34, and I like to have at least 13. Um, Total cash, they have a lot of cash on hand, so they can use that to um, incentivize their drivers to stay with their platform, and they can always also use it for advertising. They have more cash than debt, so they have 5.5 billion in cash, and they're profitable. They have a levered free cash flow of 1.86 billion per year. So the numbers look pretty good outside of the profit margin. And a lot of times the profit margin might gets better over time. You can see, okay, so they're growing at 65% year over year from this year to next year. And their PE ratio is 98. So their PEG ratio, according to that calculation, is 1.5. So it seems like they're 1.5 times overvalued right now. The important thing, let's look at their chart. This is one of the best charts that I've seen in the stock market this year. They've been overbought for several months, and there's a lot of momentum in this name. Um, in a bad market, it'll trade down to this bottom part of the trading range. So let's wait for that before we get into it because it is overpriced right now. But sometimes you got to do the research ahead of time and wait for an opportunity to happen. Let's look at the what Morningstar said about it. Morningstar said increasing our fair value by 26%, increasing efficiency and technological prowess. Okay, so they think the stock is fairly valued where it's at. It's 170. So let's look at what CFRA says. They have it as a buy, which is pretty good, um, and a target which is higher than where it's at right now. I like to read this little section of CFRA's report. Our buy reflects confidence in Dash's growth trajectory driven by increasing penetration in non-restaurant categories, international expansion, and sustained core delivery demand despite economic uncertainty. We're particularly optimistic about grocery potential, where management noted accelerating spend and increasing perishables penetration. The Seven Rooms acquisition enhances merchant capabilities, while Deliveroo provides instant access to new markets. Strong cash position and improving profitability support continued leadership. Okay, so they have a lot of cash. We said it had 7 billion in cash. They're in a process of buying companies to expand. So they bought this company called Deliveroo. I think they're based out of Europe. They do something very similar where they deliver things like food and um, other items in Europe. So they have the Seven Rooms they acquired. So their playbook is they're acquiring companies to expand. They might even buy Postmates, which is another competitor. So let's look at some more things about CFRA. They failed to give a fair value calculation, which isn't a warm fuzzy for me in my stomach. I'd rather have a fair value and really know from CFRA what they're really worth. But we'll have to wait for that. The interesting thing about this company is it just started turning profitable. Look at this earnings. We have negative, 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 negative. Just in 2024, they started turning a profit. So this is an example of a stock that's um, a lot of companies, a lot of people in the market haven't really paid a whole lot of attention to it because it hasn't been profitable. But starting in 2024, um, I like to look for stocks that have just turned this edge of from being unprofitable to profitable. And that's whenever you get the stock right around there, that's when you see a big turn in what people are willing to pay for a stock. So a lot of these fair value calculations will fill in if the company continues to execute. You can see the free cash flow is going up, and that's a positive thing for a growth stock. The revenue is going up in a straight line, which is good, right around 14% a year. So, um, all right, so it looks like this company is just starting to be profitable, and um, they have a really good market share too. Let's look at that. The state of the food delivery industry in the US in 2025. There's a chart by Bloomberg right here. You can see that DoorDash has 67% of the total addressable market for meal delivery. You have Uber Eats, which is 23% of the market, and Postmates, which is 2%. You also have Grubhub and ASAP filling out the other ones. So they have a good portion of the market. Whenever you have a 67% share of the market, you have the ability to raise prices and um, you have the ability to expand and get market share. So the things in this article that were mentioned is they hold 67% of the market. They takeout profits have increased 15% to 30% for restaurants using online ordering platforms. So if it helps restaurants be more profitable, then more companies are going to be doing this, leading to expansion of this company. So it's a smaller company right now. It's very um, because it's been in an uptrend this year. There's a lot of vulnerability if there's a war or something like that. It has a very high PE ratio, so stocks like this can be very volatile. So let's look at okay. So during the last market pullback, it went down to here. So if we have another market pullback, let's say sometime this summer, and it goes down to here, that would be the perfect entry point. As we know, this company has a great market share. It's growing, and it's going to be buying more companies to expand what they have to offer. Um, I guess ways they can expand if they bought an order entry company like Toast or um, companies that help the process of ordering or reserving a table at a restaurant. So there's a lot of different ways this company can expand. Um, all right, so we'll wait for that. Let's look at, okay, we already went through these. Okay, so, okay, it's always good to review the top holdings of the big mutual funds. And you always have to look at this list whenever there's a bad time in the stock market because these mutual funds have held these stocks for at least 10 or 15 years. So whenever we see some kind of pullback in any of these stocks, we have to keep in mind that these companies have like an unlimited potential for in, the mutual funds and companies that are investing. They have the ability to talk to the presidents of the company. They have a lot of resources for research. So we had a news story came out this week about the possibility of taking away licenses to chip firms such as Taiwan Semiconductor. So Taiwan Semiconductor is in a lot of these top holdings. We have Taiwan Semiconductor here. So we have to see if that news story is going to affect this long term. Right now, it's just a threat. So if next week we still see this stock, Taiwan Semiconductor, under pressure, we have to consider that as a stock we can to look at as potentially buying for a long-term portfolio. Um, okay. So the interesting thing about Taiwan Semiconductor, we'll look at that right now just for fun. Okay. You can see that Taiwan Semiconductor has recovered everything from the beginning of the year. And it has momentum in its chart. It's following basically the S&P 500 right now, but it's been overbought for quite a while. What I like about Taiwan Semiconductor, okay, let's look at statistics. So the great thing about Taiwan Semiconductor is they have business from every major United States tech company that does chip manufacturing, such as they have NVIDIA. They do a lot of NVIDIA's manufacturing. They have Marvell. They have AMD. A lot of companies go to them. So they're very diversified in their customers. But let's look at their cash on hand. Total cash 2.7 trillion, if this is right. Total debt is 1 trillion. So they have 1.7 trillion in cash, which is pretty amazing. Just think what they can do with that. And their market cap is 710 billion. That doesn't really, well, actually current is 1 trillion. So if they have more cash, they have 1.7 trillion in cash, and their market cap is 1 trillion. Um, there's a margin of safety there somehow. I mean, if the cash they have on hand is more than what they're trading at, there's some value there. I'll have to figure that out. Okay, but they are growing, and their forward PE is very low at 22. And let's look at their TSM. Okay, let's look at their statistics. Okay, let's look at it here. The earnings estimates for the year. Let's paste that into here. So they're growing at 31% from last year to this year. Then they're going at 19%. So their PE ratio is 22, and they're growing at 19%. So they're just right about fairly valued with 1.7 trillion in cash, which is um, pretty amazing. Um, so any pullback in this stock and they have a steady demand for their product because NVIDIA, where else are they going to go to have their chips made. The only problem for this company right now that I can see is if the current administration somehow limits what they can sell or the fabs that they can use from America. I think the current story was they might not they might not renew a license to use American technology in their chip fab activity. So anyways, we'll keep an eye on this one because it is one of the stocks in our top holdings. All right, I hope you found that interesting. I think that's about it for today. I hope you enjoyed that, and I'll see you next week.